future. So anyway, thank you so much for coming out, and we're so glad that you could be a part of this workshop here tonight, and I certainly hope you find value of it. What we're going to be going through tonight is we're going to be talking about we're going to be talking about the sole proprietors, and that can be in a bunch of different formats. Believe it or not, sole proprietors can be LLCs, they can be LLPs, and they can also pay themselves with the W-2. So some of these pieces that you're going to be seeing with the tax piece that we're going to be talking about tonight is going to be going through these five main segments that you're seeing right here. We're going to talk about the sole proprietor income, but we're also going to be talking about the five main sections and then trying to help you set up for maximizing your income as you file your taxes. And so if you want to buy a home, this is actually really good for you as far as what to do. I'm just going to give you a real quick bio as far as who I am. I've been in the mortgage industry for since 2013. Before that, I was actually the director of sales for a local builder, and managed that for a multitude of years. And so I actually started out in construction as a mobile home repairman. I don't know if you can get much lower than that on the totem pole, but that's where I started off on the underbellies of mobile homes. And then I worked my way up, and here I am now in mortgages. Anyway, that's kind of me and my history right there. And I've served since 2013. I've served over 2,000 families in buying homes. So I'm very grateful for the opportunity, and I don't take it lightly as far as helping you and establish your home ownership. Now, tonight, the big deal with taxes that we want to make sure that we talk about before this is taxes are actually necessary, believe it or not. Nobody wants to pay taxes, but just like the fairy tale of the golden goose, we kind of have to pay taxes at some point in time because we like our infrastructure. We like our roads, we like the services, we like our schools, we like our health, we like the police, we like, you name it, the fire department, we all like all those pieces of the pie. And so you can't, slay the golden goose and expect to have these pieces. And so we all have to be very cognizant that these taxes are actually designed for that very specific piece. Now, obviously, none of us want to pay taxes more than we absolutely have to. So there are legal ways for us to overcome these and in a sense, hide our share of the taxes so that we don't, not hide, but legally, in essence, not have to pay taxes on certain portions by the way we file our taxes. And so tonight, what we're going to be talking about is mainly how self-employed people in the sole proprietor arena do this, because there is a very big difference between the role of an employee and the role of self-employed in how we look at taxes. The official documentation that we use for people who are trying to qualify to buy a home that are employees is pretty simple. We're going to look at pay stubs, we're going to look at W-2s, we're going to look at tax returns. If they're just starting a job, we're going to be looking at offer letters, and we're going to be synthesizing that data and averaging it in if we need to, or just going through the mathematical approach of trying to help people through the process of buying a home with those official pay stubs and that official documentation. Now, when you're dealing with a self-employed person, it's actually very different. When you're dealing with a self-employed person who is getting ready to buy a home, we still have to use official documentation in order to establish income. But the only official documentation that we can use when it comes to self-employed people is tax returns. And there's a very specific reason behind that, because once again, there's a lot of ways for us to be able to deduct certain things, and we have to show how much money with the ability to repay in order to be able to move forward. So some people, as they try to get a loophole in it when they're trying to do self-employed setup, and they try to pay themselves with a W-2, that doesn't matter. It really doesn't matter if you pay yourself with a W-2 or if you pay yourself just by regular distributions from your income. We're going to be averaging all this information in as we look it over for the period of time that we're required to do this. Now, in some cases, we can get by with as little as 1 year of self-employment. That is not extremely common. And I'll tell you why. Because most businesses, generally speaking, do not make it past the third year. Because of that, we have to establish the ability to repay. Those are the key words that came out of the crash of 2009. Now, with that ability to repay, in essence, what we have to put together is a timeline of this being able to move forward. and that we're able to show that you have the income necessary to be able to support the payment plus all of your existing debt. Now, let's talk about the loophole of the 1 year. With the loophole of the 1 year, we have to see that your business is taking off. In other words, it has to be somewhat of an anomaly that we can prove that your income is going in the right direction. I've only been able to do this once in the 10 years that I've been doing mortgages, or 13 years I've been doing or 11 years now that I've been doing mortgages, because it's very hard to prove this. And in the case of the person that I was dealing with, he was an attorney. He was at an attorney firm. He was a attorney that was getting paid very well, and he jumped out and he was still an attorney, and his business just skyrocketed as far as income. And that's partially because of the type of attorney. He was into intellectual property, and you could see very easily that his income was stable and that it was going to continue to rise. We were able to prove very easily that this was not likely to be an anomaly and that his income was going to continually rise. That was the only time I've been able to get by with a 1 year tax return. Most of the time, other than that, we're looking at 2 years because of the way it's set up. Now, this is the typical tax form that the self-employed person usually sets up with in order to file their taxes. If you're doing a sole proprietor version of an LLC or a partnership, this would be where you would be filing your taxes. And there are 5 main components to this form, and we're going to kind of dive into these in a little bit more detail and kind of go through the details of how it works with each one of these forms. Now, if I go, you can see right in here that I got a couple of boxes that are in red and one that's in orange. This is going to be kind of like the highlights of what we're going to be talking about, but we're going to dive into it a little bit more in depth right here. First of all, if we start off at the top, this is the general information section. Now, a lot of people skip over this and think it's not nearly as important, but this is actually a very important section for you to consider, because you don't necessarily have to have a business registered with the SEC in order to be able to use this profit and loss for business. I see a lot of people who are sole proprietors who do not have their business license with the SEC. Maybe they're window washers. Maybe there are people who do handyman services. Well, handyman services, you do have to be licensed. But there are a certain amount of services that if you're getting paid underneath a certain amount per job, you don't necessarily have to have an SEC license. You don't have to be registered as an entity. So you could actually, you can see right there on the top that you could actually just have a place to put your Social Security number in. And that's actually pretty common. We see people who are not necessarily set up as businesses put their information in here, and then they can just go ahead and register their income this way. Now, there is a misnomer within our industry that that a lot of people think that if I get paid in cash, that's not taxable. Well, the IRS code actually published, believe it or not, that a section of the guide where if you're stealing money, you have to report it as income. So if they're putting that as part of the reporting guide, I would imagine that getting paid in cash also applies to this portion right here of that. So just a word of the wise, if you're stealing money, make sure that you report it on your income taxes. Just want to make sure you knew that. Anyway. There's a couple different accounting methods that you can use. The most common one that people use are the accounting method of cash that you can see right here. There is the accrual method. We don't see that one very commonly. I'm not a CPA to really tell you all the benefits or drawbacks to each one, but I would tell you that the vast majority are going to be based off of cash coming in and cash coming out, and all that is done in real time. Unless you are like a builder who has a spec that comes in at a certain time and then it's sold in the following year, and then you accrue that income until you actually write it off when you sell that spec. So that would be a slightly different setup when it comes to that. But for the most part, this is going to be kind of like the general information on how this is set up right here. Now, if we go into the different pieces of the questioning, you can see that the CPA is going to really help you out with this piece right here. Now you get to the top of part 1 of the income, and you're going to see that I have a little red box in here on box number 6. Now this box on box number 6 is actually pretty important, but it really is only going to apply to certain industries. It's not going to apply to every industry. It's called you can see right there that they have an identification in there for gasoline or for tax credits or for refunds. So what we usually see this being used for is like for convenience stores. And so like a convenience store may have, they sell gas and they get rebates at year end based off of how much gas they're selling to the public. So it's an extra way of them receiving benefit, but not necessarily in an instant cash value. They get the rebate at year end because they sold millions and millions and millions of gallons of gas. And then in essence, that rebate comes back in the form of something that you see right here. Another thing that we see commonly in this section is if you're dealing with, for example, also a convenience store or grocery store that sells lottery tickets. Lottery tickets, they pay the face value, but the commission who sells the lottery tickets pays a commission to the entity who is actually putting whatever it is that they have in their store in order to generate these tickets or other things like that. So there's a commission that comes out, but it's not part of the regular income. It's based off of how much they've actually sold. So that would be the most common way that you're going to be seeing box 6 right here. But some of this comes from other parts of the pages, and you can see that based off of how they say here from line 42, from line 3, other things like that, and so on and so forth. But your general number that you're going to be receiving as far as your gross income would show up in line number 1. And this is actually extremely important to make sure that you get the right number in there. Now, everything is digital nowadays. So if you're receiving a 1099 and you get multiple 1099s for the same business, it's a good idea to go ahead and put all of those in there, because if you miss one, the IRS is going to know. If you get cash, it's a good idea to be able to put that income in there as well. Also, if you're getting paid a W-2 from your business, some of that stuff is going to show up in that box as far as total receipts as well. Now, parts and pieces of all that play into the next one, which is those start coming down to the next box, which is the main portion that everybody uses for expenses. This is the vast majority of where we come in and we start looking at these expenses extremely closely when we get into calculating your income for buying a house. Some of these can be used in a variety of ways. For example, you can see that the car and truck expenses, which are used right here in line 9, there's a separate box on the second page where you can break it down and you can adjust it by miles. The miles are items that we can add back in. We'll talk about that a little bit more on the next page. You can see in here, there's also contract labor, commissions, advertising. These are all what are considered to be hard costs. The items that you're seeing here in blue are going to be hard costs, which go automatically straight against the income that is generated and was put on line 1 of your tax returns. Now, you can see number 12 right here is called depletion. Now, depletion is also related to companies who have a certain amount of product that may not be entirely used up by year end, but they've bought the entire product, but they haven't used all of it up. And this can be related to, for example, like a gas station. Once again, they have the big tubs in the ground and they fill those up with gas, and they may have a remaining portion at the end of their calendar year that's going to float into the next year. Well, they're going to deplete that out of their taxes, so that they, in essence, yes, they're getting credit for it, but it's a soft hit against the debt because they've already paid it going into the next year. Another place where we see this happen quite a bit is if you have a winery. A winery has big vats of wine, and these big vats of wine, they take a certain amount of gallons out every time. If some of it goes into the next year, you're going to see some of that end up in depletion. Some of the smaller businesses that we see some of this with would be items like maybe a publisher who has paper that is sitting around, or maybe also a salon who has a lot of hair products that aren't completely used up. They can take a one-time hard hit, or they can do the depletion, which happens over time. If they take the one-time hard hit, that's likely to show up in line 27, which is other expenses, or under office expenses, or in other areas that they would have for these hard one-time hits. But you can't add a hard hit back into your income. Where you can add a soft hit, which would be considered depletion, you can add that back into your income. The same thing with number 13, which you see right here, which is depreciation. Now, what depreciation is, and this is actually one that is not used very often, especially by the smaller sole proprietor. And so I really want to talk about this one for a little bit longer. It's not that the CPAs don't know how to use it. It's just that many times they don't use it because they've maximized their expenses in so many of these other blue boxes that there's no reason for them to add one more tax deductible item in line 13 when it's not necessarily a huge benefit to them when that's all said and done. They'd rather give you the hard hit and help you get set up so that they can minimize your taxes. But this is where you have to look at the difference between what a CPA does or a tax person does versus what a loan officer does. When you're going to the CPA is strategically setting you up to make sure that you're reducing your tax burden as much as you physically can. They're not taking into account that you're trying to qualify for a home. They're only taking into account your tax burden and how to eliminate it, and rightfully eliminate it. Okay, so that's a good thing what they're doing. Now, having said that, from a loan officer's perspective, you have a couple different choices as far as where you can put this. Because if you take the one-time hard hit, it's going to affect your total net number, may reduce how much you can purchase, and at the same point in time, may put you in a dire situation because we may have to wait until next year's taxes to be able to see your income going into a position to where it actually benefits you or improves. Now, number 13 is extremely important because there's a lot of people, I know there's a couple self-employed people on this call right now that have inventory. And it can be inventory that you use for, I know we have a stager that's on this call who actually stages homes and decorates homes and does all sorts of great things to help people sell homes. Well, guess what? That inventory can be depreciated over time because you are going to have to replace it once it wears out. And that's the same concept regardless of what business it is that you're in. Now you can take the one-time hard hit, but that affects line 31, which is the total net number that we start with. And so you really want to kind of look through that and decide where it is that you want to take the real hard hit or where you want to not take the hard hit and take a strategic over time depreciation of that item so that you can do this. So for example, going to the situation with a person who stages homes, let's say they have $20,000 worth of goods that they can use, that they're using in these homes. So if we take $20,000, you can usually do depreciation of over 5 years, which means that you're taking a $4,000, you could take a one-time $20,000 loss against your income, or you can take 5 years of $4,000 per year. Now, this depreciation is considered to be a soft loss. So that what that means is that you're going to replenish it and repeat every 5 years. You're going to have to change your inventory out. And so 4,000 one year, 4,000 the next year, 4,000 the next year, and so on until in the government's mind's eye, it's not worth anything anymore. And you're going to have to replace it with something else. Now, this is a soft loss that we can use to be able to help you buy the house. So in other words, we can add it to line 31, even though it's a deduction, and it's reducing your tax burden, we can add it back into line 31, which is your total net income, and help bolster your income back up. I'll give you a case in point. I had a gentleman who was a dump truck driver a couple years back, and he bought 5 vehicles. And each one of the vehicles was worth $50,000. Now, he had saved up through his business, and he had done it through his business, and he bought 5 vehicles and he started depreciating them over a 5-year period. Well, his number, line 31, was atrocious. He had lost like a boatload of money. Well, guess what? Because he had put it in line 13 as far as depreciation, now I could add that money back in so that he could qualify. Not only did he qualify for that $450,000 house, but he qualified on depreciation alone. And so that was a fantastic way of him to be able to take advantage of the tax code in order to save himself on taxes and at the same point in time still qualify to buy the house. Now, there are other places that you can take some expenses, like right here on 27A, which is on the following page. There's a place where you can actually itemize certain things that could be considered capital expenses. Like, for example, if you have an office And let's say you're a kitchen designer and you have an office and you need to put a new kitchen, I don't know, whatever vignette in. That kitchen vignette is going to cost you $5,000, but it's only something that you're going to be able to do once every so often. Well, that's considered a capital expense that is not a recurring year-over-year expense. Sometimes I can add that back into your income as well. So that's something as well to think about when you're doing this. You can depreciate it. You can do a capital expense. There's a couple different ways through it. Now let's think about some of the businesses that we see that could possibly use some of this depreciation. If you're in it, let's go back to a salon. If you're in a salon, you have hair dryers, you have chairs, you have mirrors, you have, I don't know what else you have as far as equipment, but I know there's a ton of equipment in a salon. Guess what? That can be depreciated. If you're a contractor, you've got ladders, you've got saws, you've got roofing equipment, you've got all sorts of things that can be depreciated. If maybe you're more in an office environment, you've got a desk, you've got a computer, you've got a cell phone, you've got, now some of those you can take hard one-time cost or you can depreciate them. It just depends on how you want this set up, okay? So this is a fantastic line. Line 13 is a fantastic line to help you get set up to make sure that you're setting yourself up for success. Moving on a little bit further, if you go into the other items that you're seeing right here, most of these are going to be hard hits. Now this one right here, 24B, is you can see I have that one in yellow. The reason why I have that one in yellow is actually a very specific reason, because this is referring to travel and entertainment and meals. And you can deduct meals, but you can see it also has in parentheses, see instructions. So if I see $2,000 in meals, obviously you've enjoyed your work atmosphere and you've been going out to eat and you've tried every restaurant in town. You're a foodie. That's fantastic. And when I tell you that that's only half of your expenses, now I'm really telling you that you've actually spent $4,000 on eating out because the government only allows you to use half of it as far as a deduction. And so now I have to add $2,000 back in as far as cost because that is only representing half of the bill. And so congratulations, you're a foodie, but at the same point in time, it's really going to affect you because I have to delete another $2,000 off of it because they only let us expense half of it. Now, the reason why that's important is because this is where you get to get into strategically setting yourself up for success. Okay, this strategic move, sometimes it's worth your time to avoid putting the meals and deductibles in here and try to bolster up another area where you can get some benefits, comparatively speaking, to the ones that you're dealing with as far as with the food. Now you can see this other box down here at the bottom. We're going to fast forward down to box number 30. Box number 30 is actually a very important box as well because it's, you can see right over here, it's expenses for the business use of your home. Now this is extremely important because most sole proprietors, small business owners, work off of their kitchen table. They work off of their kitchen table or they have a designated space in the house that they're using to be able to get the bills done, to be able to do the estimates, to be able to get on the computer and do research, to get on whatever it is that you're doing in the house. You have the phone that you're going to be using, you have the electricity that you're using, you've got all the components of your household that you're actually using in order to be able to get your job done as a sole proprietor. Well, guess what? You can write a certain percentage of that off. Now, I don't know the exact number, but I think it's 10%. And so 10% of your housing costs for HVAC, 10% of your electricity, 10% of your phone bill, 10% of your internet, 10%, that adds up pretty quickly. And so those are some good things to be able to consider. Now, keep in mind, talk to the CPA. I'm not a CPA. I don't know how that formula works, but this is a place where you can add money back in. You can add money back in to amplify how much you're getting, but you've already paid this in another area. So it's not something that we're going to be taking as a hard deduct. It's going to be adding it in. Now, I'm going to throw out one word of caution here on this specific piece, because every county has gotten a little smart about this now. And if you do file your state taxes or your federal taxes and you show something in this line 30, your local county may ask you to come get a business license. Okay. Now, you have to identify in your county whether this is something that's really important to you or it's not important to you, but certainly keep that in mind that you may be paying one more tax to get a business license if you put something in there. That happened to me when I was living in the Richmond metro area. I was out in Powhatan, I filed my taxes, I put $1,500 in there, and the next thing I knew, I got a bill from the county for a business license and also a personal property tax for some of the stuff that I had in my business. So just kind of keep in mind that while it is a soft deduct, you may get hit from the other hand. Okay. All right, moving on to page two. Page two right here at the top. This is the general information on page two. And we're going to go right into this right here. Page two at the top, this is really for inventory. If you're dealing with smaller, more like a retail style shop, you're probably not going to put a whole lot in here, but you do have the opportunity of breaking certain things out like materials or other items like that that you use for personal use, and so on and so forth. And then going over in here, part 4, this is a piece that actually plays into the first page. And so remember I was telling you back up here that you could, in number 9, you can put your vehicle expenses right up here. You can put your vehicle expenses in here, but the hard hit of the vehicle expenses I can't add back in. So if you only put numbers up here in number 9, which is where the vehicle expenses are, I'm not going to be able to add anything back in unless you come back over to page 2, and on page 2, line item 44A, you add in the business miles. Now, this is a very good way to get some money back because we can add, depending on the year, we can add between 26 and 28 cents per mile. You get about 60 cents per mile from the government. The CPAs really want you to do a straight line, real costs, because it's easier for them. But the miles is actually a pretty good, solid way to get some money back. And let's say that you're an entrepreneur, and I know some entrepreneurs that really put a lot of miles on their vehicle, but it's not uncommon for me to see 20,000 miles on somebody's report. Take that 20,000 miles, I multiply that by 26 cents. I can add $5,200 in income in, which divided by 12 is equivalent of almost $500 a month. So this is actually a really good way to actually bolster your income up. Now, I do need to, kind of let you know that you can see right here, there are some questions that they do force you to answer because, and these are this, if you're going to get audited, this is where it starts usually. Okay. So if you're going to use miles on here, you better be, pretty religious, like living in a monastery, like keeping very good records, because this is, if you're going to get audited, this is usually where it starts. And if you can't prove what's happening with your miles, they're going to start looking at the rest of your tax return too, because look at what it says here. Was your vehicle available for personal use during off-duty hours? So now all of a sudden you having to answer these questions. Do you or your spouse have another vehicle for personal use? Do you have evidence to support your deductions? If yes, where is it written evidence? Okay, so now you're starting. Now I know there are apps out there where you can track your miles, or apps that you can help do some of these things and put things together for you. If you're going to be doing miles, I would highly encourage you to be very accurate with them, because this is a place where I have seen a lot of people get into trouble. Okay. Now, the last piece of this final page right here is where you would put in the expenses that bleed over to the other page where I was telling you where the other expenses come in, as far as if you're going to itemize certain expenses, like if you're going to do a cell phone, or if you're going to do capital improvements or other things like that. This is where you would list what they are and what those deductions are, and then you would put the total down here and this number down here at the bottom. Now, since this is all about us trying to get you to qualify for a home and being able to do your taxes in a way that actually helps you, I'm going to share with you the next piece, which is the worksheet, or part of the worksheet, not the entire worksheet, of how we use these numbers and how we calculate and how these work out. So if you come into here, you're going to see that right off here, I put it 2 different years. And this is a big deal, because once again, we're going to be averaging over 2 years how we get this done. If you're going to your CPA very quickly or very soon, you may want to take a screenshot of this and take it with you when you go to your CPA to talk to them about how you want to file your taxes. Because these are the line items that we're going to be looking at, and these are the line items that we're going to be using to calculate your income. Now, if you're using the Schedule C sole proprietorship, whether it's an LLC or a partnership or anything that's under this Schedule C format, we are going to be using 2 years of income, and we are going to be averaging it over 2 years. And so if you see right up here at the top, last year was 42,000. This year was 45,000. That is your net profit. Look at that from line 31. Now we're starting at instead of starting at the top, we're starting at the bottom of the tax page, and then we're going to work our way back up to see how much income we can add back in. You can see that I didn't put anything in here for line 6 because I'm not selling lottery tickets. Yeah, I'm not selling lottery tickets. Okay. And I'm also not depleting any gas tanks. So now I'm leaning on depreciation. Here's my depreciation for 1 year. Here's my depreciation for another year. I ate quite a bit the year before. I ate out quite a bit less this year. I used my home for an office. I did the miles that you can see right here. I got 26 cents a mile for last year, 28 cents a mile for this year. And then here is my total mileage that I get to add back in. When I add both of now look at this. Notice this right down here. This is actually my net income based off of adding all these pieces. Now my net profit was 45. This is what I'm getting taxed on. I'm getting taxed on 45, but I actually have effective income of 61,000, which is actually pretty cool, right? Because in essence, I'm getting taxed on $15,000 less than what I truly can use to help qualify for this house. So that's a pretty good deal. Now, the downside is if you had 1 year that wasn't as good as the other, you can see that down here, even though we started off with 42,000, which is only $3,000 apart, we didn't maximize our depreciation. We had quite a bit more over here in meals. We didn't use the business use of our home. We had less miles. And so in the end, I ended up at 49,000. Well, if I average these two together or take both of them, add together, divide by 2, it comes out to effective income between the 2 years of 55,300, which is less than the effective income for 1 year. Now, keep in mind that what's happening here is that ever since 2009, we are forced to go with the most conservative option, because we have to prove, based off of the laws that Freddie Mac and Fannie Mae have put into the guidelines, we have to prove beyond reasonable doubt that you have the ability to repay. Those 3 words govern everything that the mortgage lending world does: ability to repay. So what they're going to do is they're not going to use this top number. Instead, they're going to sandbag it with a number from the year before, come up with a number that's in between there, which is, I mean, that's $6,000 difference roughly, which is a fair amount of money per month. That's like $500 a month right there. And that gives me an effective income down here. Instead of the 1 year income, which would be 5,000, it's given me an average income of 4608. Now, this is the number that we're going to use to help you qualify. So this is extremely important that you see how this math is done, so that when the time comes, you can set yourself up for success. Because the CPAs they're extremely good at saving you money, but they don't necessarily, because of what happens with the mileage, they know that they don't want to put a whole lot in this space because they don't want to get the audit and they don't want to get going. Now, having said that, let's talk about audits for a second, because here's the job that the CPA has. He is going to be spending the time gathering his information from you. And then when he is done with it, he's going to have you sign that the information that you gave him is authentic. And then he or she will submit that file to the IRS, either through an e-sign or a paper sign or whatever method it is that you've chosen to go with that CPA or that tax preparer to submit these taxes. Now, keep in mind that they're only submitting what you gave them, and they're having you sign that this is authentic and real, and that they have put that information that you gave them into this file. So if an audit does come around, the burden of proof is not on the CPA, it's on you. And so keep in mind that this is a big deal as you're starting to get into this, because the CPA is going to front the information that you gave him or her, and they're going to front the information from whatever it is that you gave them. And if there are gaps, it's up to you to prove that. That's why I said the miles are such a big deal, because most of the time that's kind of etched in jello. I had one person that put 100,000 miles in there. I have no idea how they're going to prove 100,000 miles. That's a massive reach, especially for the amount of income that they generated for that business. And I can almost guarantee you that with the 86,000 new IRS agents that they just hired, that it's very likely that they're going to get audited. And so just kind of keep in mind that these are parts and pieces of how to put that together. Now, I've pretty much wrapped up on the content for tonight. You can see there's not a whole lot there. I'm just going to share with you a little bit of how I work, and then I'm going to open it up in case you have any questions as far as what I've covered. And if I do have the answer, I'll certainly share it with you. Otherwise, I may have to connect you with a CPA who might be able to help you. And this is my 30 seconds of spam. Okay, my 30 seconds of spam right here is I actually work very differently than most everybody else, because I try to devote myself to my clients' needs before, during, and after every transaction, because I only work by referral. And that's extremely important. I'm extremely busy right now because I only work by referral, and I want to make sure that I keep it that way, because my competitors, what they do is they do cold calls, they buy leads, they pay for partnerships, and that really dilutes their ability to really get in and try to help people at a very high level to accomplish their goals, to accomplish what they're trying to do. Whereas I can do things like this because it's so important to me to be devoted to my clients before, during, and after each transaction. The only thing I ask is that if you like what I do and you want to work with me, and you do work with me, and that after the fact that you would just refer me people just like you. That's it. That's my strategy, and that's how I've built my business over the last 11 years. So thank you for that opportunity. Here's a list of other classes that I do, or content that I have coming up, other events and classes. If you'd like to be a part of them, these workshops are all coming up very quickly. And, you know, by all means, if you have any questions, I'm just going to go ahead and open the floor. Last night, I did this one last night as well, and we had a little problem unmuting people, but if you do have a question, we'll certainly try to get you squared away on this. Anybody with a question?
Hi, Chris.
Yes, ma'am.
Oh, no, go ahead.
Okay, thanks, Brenda. This is Joni. So my question is, going back to that number, the 4,600 a month, and I know that there's a lot of factors involved, but just so I understand moving forward when I'm thinking about getting a mortgage, about what is the percentage that you as a loan officer would be looking at that would go towards the mortgage out of that 46?
That's a great question, and I specifically avoided that one because it does depend on the type of mortgage that you're trying to get to. But I'll answer it in general terms, and we'll kind of go with this. So when we're pulling it up, and the 4608 is the number that we're using, we can use up to 45% of that with one certain program and 50% with the other program in order to qualify for all of your debt and the new house. And so if that means that based off of 4,600, 4,608 per month, that would be your maximum debt load that you could afford with your credit cards, your car payment, your student loans, and your house, or anything that might be on your credit. Does that help, Joni? Oh. Maybe that helped.
There we go. Yes, that helps a lot. Thank you very much.
Okay, and so as far as your purchasing power, that's really going to depend on how much debt you have. Right now, this would put you at about 300 as far as a purchase price, but that also depends on how much money you're putting down. So there's unfortunately there's a lot of variables here, that I may not be able to answer specifics, but I'm certainly happy to answer them offline if you'd like to connect with me.
Mhm.
All right. Any other questions?
Yes. Hi, Chris. This is Brenda. Look, I did have one question, and actually, the previous question answered one of my questions, which is how much would you take? That you calculate. You said the 45 and the 50, depending on the product. The other question that I had, you mentioned about the 1 year is an unusual tax return, where you gave the example of the attorney. Typically, are you still looking at 2 years, or is it the 3 years you said?
We always
Before.
try. Yeah, that's a great question. So we're always trying to get 2 years. We're trying to get,
Two.
we try to get a really good solid work history to understand what people have done. Because sometimes that work history is going to be what's called in our world a compensating factor, which, this goes back to, I love Shrek. So Shrek and his example of the onion, where he says, it's like an onion, donkey. It's like an onion. We have layers. It's the same thing with mortgages. There are tons of layers when it comes to risk and different things like that. And so when we're dealing with somebody's situation, we want to look at the history that they have. Now, if I have a strong history, then I can fight for that history as long as I have a strong record of this. And so here's what I mean by this. If this attorney had come in and let's say he was making $150,000 a year as an attorney for this firm with a W-2 employee, and his income had gone from 150 to 75 in the first year, I can't make that argument. I just literally, there's no argument that I can make that's going to make that make sense. If his 150 turns into 175, it's possible I could make that argument, but man, there's so much to prove that it would be really hard to make that argument. But if he's going from 150 to 300, now I've got an excellent argument. This guy not only knows what he's doing, he's done it in the past, and it's going in the right direction. And he's putting X down, and he's doing this, and he's doing this, and he's got savings. So when we start looking at the layers of the onion that we're putting together, the compensating factors is, does he have a history doing this? Does he have good credit? Does he have good savings? Does he have a pattern of savings? And the biggest one, those three wonderful magical words, does he have the ability to repay? And if I can pull all of that together, I can make an extremely airtight case for helping this person buy it. But if I have somebody coming in wanting to do this, they got a 620 credit score and their income is going the right way, I just don't have the compensating factors to be able to overcome it. And so you have to think, when you're thinking about some of these, we have to think about it kind of like the bank does. Would I be willing to take my wallet out and put X amount of money in this person's hand to buy a house? And would they really have that conscientious ability to make it work? And so does that answer your question, Brenda?
Yes, it does.
Okay.
It does. Thank you. Appreciate
Okay,
it.
good. Sometimes I have to go back and unmute everybody while I'm doing this. So
Yes.
sorry about that. I haven't figured out how to stop that. But anyway, all right. All right. Any other questions? Anybody else might have a question out there? Anybody? Going once? Going twice? All right. Well, I want to thank everyone for coming out tonight. This is my contact information. If you'd like to connect with me afterwards, I would love the opportunity to connect and help you in your strategy. And once again, I'm never too busy for you. Obviously, tonight's a little bit later than what I usually go with, but happy to serve you and help you and your family and friends at the same level. So thank you so much for coming tonight. I look forward to serving you and yours in the future.
Thank you, Chris.
Thank you so much.